Hi to everyone and welcome. Sorry for the delay. First of all, there was some technical problems with the transmission, but here we are with you in this seminar that is really a follow-up from last year's seminar that Miguel organized. Miguel, good morning.
Hi, Jorge. Great to see you.
Great to see you. The markets are really bumpy. They are bubbly, and I might say they are euphoric in certain elements. And we all will be very interested in hearing what our speakers have to say about those markets. And I would like to introduce an amazing lineup that we have for today. And if you are with us here this afternoon, I would like to say hello to David Costin, which is Goldman Sachs Chief Equity Strategist. He's responsible for analyzing and forecasting the US stock market. He has been with the firm since 1994. David, good afternoon, and thank you for being with us. And we also have Andrew Goldberg. He's JP Morgan's Global Head of Market Strategy and Advice. He leads a team of strategists to develop comprehensive macro market and investment analysis. And Andy, thank you also for being with us this afternoon. And we have also, yes, here's Andy. Thank you. And we have Miguel Valle, who is Tec de Monterrey's CFO and head of the University Endowment. Prior to this role, he worked for Jefferies and JP Morgan in London and New York City. Good afternoon, Miguel, and welcome. My name is Jorge Arturo Martinez, and I'm the head of the financial think tank Aregade, Center for Applied Research in Monterey Tech. I'll be your host this afternoon, and thank you everyone for being with us. And Miguel, I leave you the floor to discuss about the topics for today.
Thank you so much, Jorge, and welcome everyone. We're so excited to have you again in this panel that we think is very relevant to understand the happenings in the market since last year when the pandemic started. And we have the privilege to hear from David and from Andrew great views about what was going to happen. And now we can revisit those views and think about where are we going to go now. I would like to kick off this discussion with a graph that is going to show us what has been happening in the US market that reflects in some way the global market and the sentiment in different sectors. So if we get started and we remember, we were back in February of last year, we were reaching record highs, and it was great times. There was a lot of optimism. Then the pandemic started to hit, people started to worry, and we faced the quickest decline in the market history. In 22 trading days, the market fell by 34%, as you can see over there. We reached a bottom of 2,190 points on March 23rd. There were very scary days, as you remember, where we didn't know where the economy was going, what was going to be the type of fiscal support, how would companies survive. But actually, eventually, a few days later, the US government enacted the CARES Act for $2.2 trillion. And that was also a reflection of what other governments in many developed countries were doing. That created this mountain, this climb that we see over there, where there was a big rally in stocks, especially those stocks that were tech stocks, growth stocks, that gave a lot of hope into the future. They were benefiting from the lockdown. Companies obviously like Zoom, like Peloton, Tesla in some way was also growing a lot. And then we go into the middle of the graph, which is we get into the summer. And the summer, a lot of people start going out. There was a lot of concern about the second wave. And it was starting to be again, uncertainty about what could happen in those southern states, in Texas and California, in other countries, in Europe. So that was short-lived, actually. And then we go into August, and actually David, that is with us today, made a prediction that the S&P the market would finish the year at 3,600 points. We were back then around 3,300 points, and it was, again, a lot of uncertainty. We still didn't have a vaccine. It was a bold statement, and actually, David, kudos to you, you were spot on. The market ended up a little bit above the 3,700 points. We move into September, and again, lockdown concerns. People felt the impact of having the economy shut down for a few months back in March and April. So they were very concerned about that, and there were 4 weeks of declines that were very impactful in some markets. However, we went through that, we survived that, but then the elections, the US elections were coming in. There was a lot of volatility, especially about this blue wave that could happen and bring Democrats in control. That was again short-lived. It recovered, and we moved quickly into, again, a post-election rally where Andrew Goldberg published his top market takeaways. And this was also very interesting to read because he was recommending about diversification, going into quality assets, diversifying into value stocks, into dividend growth stocks, and that also proved to be quite a good recommendation and timely recommendation with a rotation from growth to value. Very quickly, we had finally the vaccine that we were waiting for from Moderna and also from Pfizer with very high efficacy. And then we move into this year where we see all these frenzy around retail investors that were new to the market. They were reading blogs in Reddit and other places, and they started acquiring a company called GameStop that we can talk a little bit about that, but that was a big bubble about a company that is a video game retail company that is being under a lot of pressure from the crisis and the lockdown. So after that, the economy is going very well, and there are a lot of inflation concerns. Treasury bills start to yield 1.7%, a level we haven't seen in more than a year, and people were starting to face that to think that interest rates were going to be edging higher, and that was a lot of concern, especially around growth sectors. But finally, the vaccination progress is very relevant in many countries, especially in the US, and that's what leave us right here in the market right now in May. So I want to go first to David. Where are we right now? What is the sentiment, and on especially this recent volatility? What do you make of the market?
Thank you very much for inviting me to participate again. I would say the big issues that portfolio managers and investors are dealing with right now is a concern about inflation. The readings have been quite elevated, was expected to be high, but has come in above expectations. And that has raised concerns, of course, with respect to interest rates and whether interest rates themselves would be moving higher, and particularly whether the Fed, the U.S. Federal Reserve, would have to be raising interest rates sooner than expected. And so those, I'd say, are the two principal issues that are animating portfolio managers. And when I say that, animating, meaning what does that imply or suggest that they need to react and respond as a fund manager? Well, the idea of higher interest rates means that the future cash flows well into the number of years into the future become less valuable as interest rates rise from a discounting back to the present time. And so a number of very popular, very prominent, what I refer to as glamour stocks, particularly in the software industry, which had such spectacular performance last year, up 400% in many cases, because they were benefiting from COVID and the lockdown and the importance of digitization and all of the changes that happen in society. Those stocks did great last year as rates were particularly low. But as rates have started to back up and as concerns about future interest rate increases have come to the center of attention, those stocks have really been affected. They're down in many cases 40% this year. So I'd say the two big issues that everyone is focusing on are, number one, the idea of inflation. What does that mean for interest rates? And then one other extension is the idea of the US economy peaking in terms of the rate of growth this quarter, and then starting to slow and decelerate through the balance of this year and into next year. So still growing, but at a slower, reduced rate. And other areas around the world, outside of the United States are still accelerating, and the growth is improving as the vaccinations roll out at different speeds in different countries. But broadly speaking, as that becomes more of an issue, that would allow other countries to be growing more rapidly. And so the handoff of growth from the US to other areas, excuse me, I would say is another big topic, and that has portfolio implications. So I'd say those are sort of three big issues. Broadly speaking, we're reasonably optimistic on the recovery from an earnings point of view. Valuations are very, very stretched. I'd say that's a good summary as I see it for the market right now.
Thank you very much, David. Very insightful. Now, I would like to turn to Andrew. If you want to share with us, what are you hearing from clients, and what have your views changed recently?
Sure. Well, thanks again for having us, guys, and it's a pleasure to be able to share the stage with David. David's as good as it gets on Wall Street, so it's always a pleasure to share the stage with you. Look, he hit the nail on the head. Clients are asking us a lot of questions about inflation. The reason it's so important, and rising interest rates are so important, as David said, is there are questions about how much the market has already priced in terms of good news and the recovery. And if you assume that the Fed is correct in saying that inflation is not a really big problem and rates will stay low for a long time, it's easier to accept that there's more runway for the market as the economy continues to improve. But if you assume that interest rates are going to be higher, it means that today's valuations are much, much fuller. So they're asking us a lot of questions, about that. There are some other issues in the market that I tend to regard as, they're either trends or fads that may, in the long run, prove to be distractions. Like a lot of questions about crypto, a lot of questions about SPACs. Some of that has come out of the market a little bit. A major index that tracks SPAC values is down, call it 25%. A lot of those big growth names that, David, I think alluded to are down 35 to 40%. So that's taken some of the angst out of the market in terms of the fears that people have. But I think it's important to dissect, we should probably get into, and I'd be curious to see if we're aligned in the way that David and I are seeing the inflation picture unfold, because that is really the foundational, crucial issue here. And you've got unprecedented amounts of stimulus, and a situation where the workers that you need to come back into the labor force in order to absorb some of the demand and help offset some of that demand by increasing the supply. Right now, there are these big bottlenecks because demand, walk around New York City, which was pretty conservative during COVID, a lot of masks, people really stayed home, followed the lockdown mandates. New York is back, it's flourishing. But there's still 9 million workers, across the country that aren't back to work yet for various reasons. So some aren't comfortable going back yet. I think the jobs are largely there, but some aren't comfortable yet. Some of them, in particular for women who've been really, really hard hit by the COVID downturn, probably still have to do some work to figure out childcare and things like that in order to come back. And then there's an argument to be made that with the stimulus and unemployment benefits still coming, maybe some people don't have the incentive to go back yet. And so the lack of labor to provide all these goods and services aren't there to meet all this new demand. And right now you've got this bottleneck, and that's driving prices higher. So I think the big question is, how long does that last? Is it semi-permanent or temporary? And that's going to give you a better path towards understanding how much room is left for the market, how long can this cycle go on for, in a world where David, was spot on. The pace of the growth that we're seeing, shooting out of this cannon in the recovery, that's going to peak. So I think those are the big issues, guys.
want to revisit in the conversation. So you want to talk about questions?
Yes, to our audience, I just want to say very quickly that any questions that you would have, please feel free to send them to the chat that is in the microsite, and we'll be processing those questions and then directing them at David and Andrew and Miguel. Thank you.
Thank you so much, Jorge. So before we jump into exploring some of the topics in the opening remarks from both David and Andrew, I want to take you back to last year and some of the remarks that they were actually, or the predictions that they were both making a year ago. So let's first go and see what David was telling us back then. Let's have a look.
One is focusing on 2020 earnings. They've all moved forward into 2021. So the whole discussion is about what amount of profits companies will be able to generate in 2021. Now, from an economics point of view, depending on your assumptions, and my colleagues in economics research at Goldman are assuming that the economy in the United States by the end of 2021 will be back at roughly the same size as the economy was at the beginning of this year.
So I think, David, your economists were spot on. How do you feel about those remarks, and how have your views changed in that sense in terms of earnings?
Well, it's great to see that picture. First of all, I'm now in my office. Back then I was from my house. So that's one major difference. When I reflect back on a serious basis, when I reflect back on that observation, it actually is turning out that it'll be in the middle of this year, really in the second quarter we're in right now, that we expect the U.S. economy will be back to the size that it was at the end of 2019 before the pandemic. And that's both on a real and a nominal basis. This will be a crossover quarter. And I think the point that I was making at that time was that portfolio managers, which typically roll forward and think about profits in the following year, sometime around July or August is typically the time they really begin to move forward and think about the growth into the following year. My point at the worst part of the pandemic was everyone was looking through appropriately from an analytical point of view, looking past the 2020, knew it was going to be a difficult, terrible year on a human tragedy point of view, as well as on a corporate profits and business and societal changes, and looking into the earnings prospects for 2021. Well, the same thing is happening now, because it's not that relevant what the growth rate is from 2020 pandemic low to 2021 this year. What's more relevant is this year into next year. So already now, portfolio managers are focusing on the expected earnings and the path of profits and margins and expenses, things like that, into 2022. So I look back and I think, well, what's different is I'm in the office, used to be at home. And what is the same is that the idea of really at a very early stage in the calendar, looking ahead at what the outlook is for next year. And in fact, that's one of the reasons why the idea from a fund management point of view, the cyclical recovery is still benefiting right now. The startup, the reorientation, reopening of the economy. I was on an airplane Tuesday. People are back in the airports traveling. Some of the planes were pretty close to full. Some were like 75% occupancy. So again, as more and more people are vaccinated, business is becoming more normalized. That is definitely being reflected in more cyclical stocks doing better. You saw that in the most inflation data. You see airline companies, some of the railroad companies. There's still huge bottlenecks involved in transportation on the shipping side. Semiconductors, lack of semiconductors means the automobile industry, there are no new cars available. There's a huge premium for used cars. There's literally no cars available. They're all physically built in many cases They just don't have the computer chips that they can put into them. And so it's an interesting dynamic in many different industries. There's lots of inflation. As Andrew indicated earlier, difficult to get employees for many companies. And so that's, I think, made it difficult in the actual restarting. There's a lot of different reasons for that he described. And so when I think about it, what's different is really that everyone's now focusing on 2022. And therefore, the other item that's really going to be a big risk factor as we move through the summer is taxes and the idea of higher corporate tax rates in 2022. We are expecting there will be corporate tax reform passed, signed into law, probably sometime in the fall. That will raise the corporate income tax, essentially reversing a lot of the lower taxes that came in 2017 and at the end of 17 that Donald Trump had pushed through. And so lower taxes. So that means less profits for companies. They have to be more judicious and thoughtful about how they allocate their capital. There'll be less of it because tax rates will go up. And then you have higher capital gains taxes for individuals who are investing in the stock market. And so there's some headwinds, both from a earnings point of view, that's higher corporate taxes, lowering earnings, and valuation point of view, which is the higher capital gains taxes, will offer an incentive for some individuals to choose and sell the shares and to pay at a certain tax rate, as opposed to continue to hold the shares and pay at a higher capital gains rate. And history shows that typically the market is weak, stock market is weak ahead of those changes and increases in capital gains, but much of that gets reversed in the following 6 months. So it's a little bit of a timing issue. So I think those are some of the issues as I reflect back on a year ago when we last had this conference in terms of the differences between then and now.
Jumping into that tax risk, do you really see an upcoming sell-off that could actually materialize if the capital gains tax apparently it's going to double? So do you think a lot of people will just take gains from all those growth stocks and there will be a big kind of correction in the market from that? And how do you see that?
So I apologize. It's not always so easy to hear the question that you asked, but I think the question related to the capital gains and what the impact would be longer term. So experience is that in the year ahead, in the 6 months before higher capital gains are introduced, the equity market, broadly speaking, does poorly or is not particularly strong returns. It is most acute for the momentum stocks, the stocks that have done really, really well, where portfolio managers would be individuals would be a seller of the stocks. Just to put some very clear numbers around this, the current capital gains rate is 20%, 20% rate, and then there's a surcharge, 3.8%. So effectively, it's around 24%. The proposal from President Biden is to raise the tax rate effectively to around 44%. So the difference between paying 24% and 44%, obviously very significant. Not clear at the present time whether that will be enacted. It's obviously a point of some negotiation that will take place, but it's a risk. And therefore that could be a headwind, and experience would suggest there's some selling pressure. But as I said earlier, experience also shows much of that is reversed in the months after the tax increases take effect. So if you think about it, your investment horizon is critical. If you have a near-term horizon, well, you want to be tactical thinking about that when there may be selling pressure. But if you're a longer-term investor, then it doesn't have such a significant impact on performance.
Yeah, guys, David's exactly right. I think the key thing for investors to figure out is, because clearly when you raise taxes on essentially the cost to sell your stocks, that has an effect on the decisions that stockholders make. and then when you raise taxes on corporations, it changes the equation in terms of how much or how valuable a company's cash flows are going forward, because they get to keep less of what they bring in revenue. I think one of the things that market has to weigh is how much of a headwind are those factors, because it's indisputably a headwind, relative to some of the expected tailwinds related to the recovering economy, getting those 9 million people back to work, and then some of the fiscal spending that you're likely going to see in the form of things like infrastructure, which have good, healthy, long-run positive multipliers for the broader economy. That's a lot of money that's going to continue to get injected into the economy. I will tell you, it's very hard. Like, economists are a little bit split on whether all that spending and momentum outweighs the cost of the equity market. But what you're seeing now is, like, just think about it. The stock market is up, more than 80% since the lows from a little over a year ago. You've seen a little bit of a pretty significant rotation. That most of that 80%, when the market was up, call it 60, 65%, most of that was about the tech stocks. Since about January, since we had that blue wave, it's all been the cyclical stocks winning at the expense of the growth stocks. Now you're at this settling point where the market's got a pretty good understanding that COVID turned out to not be permanent. So the world's gonna go on, and you've got to figure out, how to weigh some of those, tax increases on the value of equities against the still recovering economy and spending that'll favor the economy. And so there's going to be much more what I view as a healthy market that's grappling with countervailing forces, instead of just a close your eyes, it's a straight line up. That's not how markets usually are. Markets are usually like this. And so those are the forces that we're going to be watching for going forward.
Great, thank you for that, Andrew. And actually, I'm going to take the opportunity to revisit what you were mentioning a year ago. If we can have a look.
With interest rates so close to zero, of course, people will be willing to pay a little bit of a higher multiple. But you have to remember, everybody, that in an environment where things are recovering enough for the market to get that high in the first place, you'd have to also assume that interest rates can't stay at 0.65%. An environment that improves that much would beget higher interest rates. So something's got to give.
Something's got to give, Andrew. So
yeah, something's got to give.
Right?
Really not this shirt that I probably have been wearing every single day for a year. Anyway, I'm sure you had a question there.
No, actually, I think it just was obviously self-fulfilling, and we see where yields are right now and the expectation of some Fed action. I think it will be interesting to hear from both of you, your thoughts around what the Fed should be doing going forward, and also about this, what you touched on, Andrew, which is this inflation that David was mentioning, used cars at record highs, 12% increase recently, all the gasoline increase, obviously the airfares are super expensive and so on. Is this permanent? This 4.2 read that we saw yesterday, is that real, or are you comfortable that we will move through and it's more a temporary effect of reopening and just the bouncing activity?
Guys, really important. Yep, really important question. That's the key. Look, the inflation that you're seeing right now is non-permanent. The Fed has been very clear that they believe that you'll see inflation in the near term and that it's going to likely be transitory. So we know that, for example, right now the price of timber, and it's not even like the wood that's expensive, it's like the wood after it's fashioned into a 2x4 is expensive because you're still having a bottleneck at the factories to get stuff made. Okay, that's transitory. We feel comfortable with that. The bigger question is, how fast do we absorb the spare capacity in the labor market. So again, if you look, there's one of the measures that our economists look at, and I know David's team does as well. There's a measure called the labor force participation rate. So how many of the available workers are actually either working or looking for work? And we narrow that down a little bit further and look at the labor force participation rate for, I think what they call the core, what do they call it, David? Like the core working age? I'm having a brain fart here, but the idea is people ages 25 to 55. So they're out of college, they're in the prime working age, right? And at age 55, they're still quite a ways from retirement, let's say, okay? Normally when you get to a tipping point in the economic cycle, where you're late in the cycle, you've absorbed as many possible people that you can in the labor force, that number, that ratio gets right up to around 81, 82%. And that was true in the late 1990s before the tech bubble burst and the economy was tight. That was true in 2006 and 7 before the financial crisis. And it was also true in 2019. We didn't know that COVID was going to come, but we did feel that it was late in the cycle. At that point, the Fed had already raised rates 9 times. Today, if you look at that measure, it's not 80 or 81 or 82%. It's in the mid to high 60s. These things take time. So the key point that I want to make is that the real inflation that people are concerned about, the deep-rooted underlying inflation, that's the kind that precipitates significantly higher rates and a real shift in corporate behavior and profits. In order for that inflation to manifest, in our view, you need to see sustained wage inflation. And you're seeing wage inflation today because there's a shortage of available and willing workers. That's going to change. So we think you're going to have several years, 2, 3, maybe more years, where as the vaccine gets further, like keep in mind, we're only a couple months into the vaccine. Once the vaccine's more widely distributed, once people are a little bit more comfortable coming out, once some of the unemployment benefits wear off, we're going to have 8, 9 million people to tap into, get them back to work, alleviate some of those constraints. And only a couple years from now will we be talking about wage inflation and real deep-rooted underlying inflation. And only then will we be worrying about, the cycle. So it's going to get a little weird for the next few quarters as the growth rate peaks and slows, as tax rates come in, and as we're struggling to find available workers. There's also all kinds of weird stuff like the hack on the colonial pipelines, creating gas shortages. That's going to add to inflation pressure. That's a weird one. Look through those things. You've got some room left in this cycle. Once you see that prime age worker labor force participation rate up in the high 70s, not the high 60s, we'll have a different conversation. That's David, what do you think? Am I somewhat on the right track?
No, I would agree. I think the big debate is transitory. That word, How long is transitory? Is that 6 months of higher inflation that we're going to be getting these readings? And that means for the next 6 months, investors will be very, very concerned about the prospect that higher inflation will lead to the Federal Reserve having to raise interest rates sooner than currently expected. And the current expectation is sometime in late 2023 or early 2024 that rates will have to move higher in terms of the short-term interest rates, federal funds tightening. So that's sort of the big question from a financial point of view. And as Andrew indicated, the idea of drawing more workers back into the labor force, that's ultimately stimulative to the economy. And these individuals, keep working, getting money, consumers spending. So that's an argument for why you get an extended economic cycle. An extended economic cycle, broadly speaking, is supportive for the equity market and stock prices going higher. So I think the tension is over the next several months, we'd expect probably volatility to remain high, higher than it had been for a while. It's likely to get more muted or more modest equity returns. Historically, that's what's happening. The ISM, which is one measure of business activity, peaked and is now decelerating. It's coming down, still growing, still expanding, but at a slower rate. That's more consistent with a mid-single digits kind of a return for the equity market. And I think that's what investors should be anticipating in the year ahead.
Sure.
Bingo. It's what's funny about the whole dialogue, guys, is that there's a lot of consternation around this topic of inflation and rising rates. In order to get sustained inflation, and in order for the Fed to start their rate hike journey, like, by the way, first they have to talk about raising rates. They're not doing that yet. Then they have to actually talk about it some more. They remember the taper tantrum in 2013, so they need to get the market to assimilate to rising rates. This all takes time. But the path to the Fed raising rates, 100 basis points, 200 basis points, that road, that journey is paved with growth, right? So in an environment, if you ask yourself, what has to happen in order for the Fed to get to the place where they're concerned enough about sustained inflation to raise rates a bunch of times, what you have to see is continued growth. And with continued growth comes continued revenue and profit growth. The runway again, what we're pushing back on with clients is that they read and see inflation should be a concern, and there's a couple different sides on that, and how transitory is transitory. That's a big debate. We're trying to just remind clients, it's a healthy debate, it's a good one. It's good to see the market being a little bit more discerning. But look, this is a multi-year road paved with growth in order to get to a problem point, during which time stocks climb that wall of worry. They're benefiting from a stronger and stronger and stronger economy. You just got to keep your foot, kind of on the gas when it comes to stocks. Expect more modest return. David's spot on. You're not going to get another 80% up over the next 12 months. That already happened.
Yes. Well, a question that's coming, and a question that I have also in this topic of inflation. If it's transitory, then a hedge against inflation would be an overkill, kind of. I mean, people who are thinking of long real assets or gold or materials companies and heavy on industrials and so on, and tips, the Treasury inflation protected, which are very expensive, well, maybe will get more expensive. So that will be not only a risk, but an error, according to this view of a transitory inflationary epoch?
I'll just take the first stab at it this way. Yes and no. What matters is, how does inflation come in relative to inflation expectations? And so there's been a period where, after there was a bad job report a week ago, and the market basically took that as, the runway's even longer and inflation's even further off for a second. And the market on that day was essentially pricing in zero risk of inflation. Well, zero risk of inflation is wrong. I don't think there's a high risk of underlying inflation, but inflation hedges do well when inflation comes in a little bit ahead of expected inflation. And so I think it makes some sense to be thinking about some inflation hedges. By the way, for now, at this part of the cycle, what the best inflation, David will probably agree with me, I think, the best inflation hedge is stocks right now. Because when low inflation becomes less low, it means a weak economy is getting better. Good for stocks. It's when high inflation is going higher that you have a problem, and then you need the gold and the other stuff. But right now, if you want to hedge against the risk that inflation becomes an issue, you want stocks.
But for yeah.
Do you want to add something there, David?
No, I agree completely with Andrew on that. They really need but the idea of higher inflation means that companies are charging more for their products. They are able to pass some of that through. Again, we look at companies with high pricing power. So if you think about the gross margins that companies that have high and stable gross margins, by definition, have exhibited behavior that shows they can pass through increases in their prices, their raw materials prices, through their value chain into the end markets, and maintain relatively high margins. So there's some individual companies in different industries that really would be emblematic of that ability. On the other hand, you have other companies that are just price takers, and they have very high input costs, which is going to squeeze their margins. So big topic of focus is identifying or trying to identify companies that are in a position to maintain or ideally even improve margins. Margins recovered in the first quarter of 2021, right? Just the quarter that we just finished from a reporting point of view. And margins have rebounded pretty significantly to the new all-time highs. It's like 11.6% on net margins. That's a big development. It is one of the arguments to owning the largest cap U.S. companies. And one of the interesting dynamics of the U.S. equity market, and I know we're focusing right now on the U.S. equity market, we can look globally in a moment, but if you're thinking about the U.S. market, 5 companies constitute 22% of the equity capitalization of the index. It's Apple and Microsoft and Amazon and Google and Facebook. Those 5 companies, 22%. Record high levels of concentration. You did have in the fall last year, it spiked to around 25%. But to put this in perspective, the 5 largest companies are typically comprising around 14% of the market. So really, very significant concentration in the market. It's point one. Point two, what's unique about these companies is that in the second quarter of last year, at the worst point in the pandemic, when revenues for 495 companies fell by 7%, sales for these companies were up around 18%, in a pandemic, in the worst part of the pandemic. This year, in the first quarter, when sales for the typical company grew by around 8% year over year, 8% in the first quarter, those companies I mentioned, top 5 stocks, had revenue growth of 41%. So you had this sort of durability of the revenue growth in both the down cycle, which is unusually severe and acute, as well as in the recovery, they're also benefiting. And so they have this sort of positive dynamic, number one. And then number two is they're investing an extraordinary amount of their cash to keep growing the business. And I would say this is the one distinction that we look at very carefully on individual stocks, because the typical company reinvests around 11% of its free cash, its cash flow from operations, 11% of its cash flow from operations back in the business. Now I'm defining that as growth CapEx, so capital spending, plus research and development. So growth CapEx means CapEx in excess of depreciation. You always have to spend some money to maintain your plant, but anything above that is your growth. So you get your growth investment and your research and development dollars. You put those together, 11%. Now the stocks I just mentioned, they are in reinvestment ratio of about 65%. So not only are they growing rapidly, but they're investing to accelerate their growth rate. That's pretty unique. Not all companies choose to do that, or not say choose to, but may not have that array of opportunities to do so. And we're driving that growth. So I think those are some of the issues that fund managers are looking at inside the equity market, looking at companies with a high degree of pricing power, passing through that inflation that Andrew and I have been talking about, because it's such a fundamental issue that investors are concentrating on now. That's the inflation story. And then there's the growth story. In an economy that's decelerating, growing at a slower rate, these are companies who are leaning into the growth, and those stocks have actually done better. And those are sort of two ways to think about, two ways that we're focusing on in terms of identifying stocks people want to own.
Yeah. No, that's great, David. Let me show you a graph and actually go into that point about FANG that you were describing very accurately. Let me see if we can display this, the following graph about valuation. And that valuation that we are right now at 22 times forward earnings for the S&P 500 actually is a bit disguised, right? Because I think 29 times earnings is for the FAM companies, for the big tech, and I think a much lower number, 15 or 16 times, is for the rest of the market. So I think in that sense, see if the graph appears or not, but in any case, do you see those valuations as something reasonable? I know it's also because of the discount rate that creates that overshooting effect, but also ask you about the monopoly risks. I think this administration wants to enforce some more action. I mean, we're seeing China, all the things that they're doing on their tech companies. Do you see that translating over this market? There is a graph.
Andrew, do you want to go? Or
yeah, sure. I mean, sure. I'll take a stab. First of all, we're getting treated to a master class here by David today. I mean, like, I think, I would go back and re-listen to that bit about, like, in an environment where the overall growth rate is going to be slower as we're, we shot out of this cannon after the COVID recovery, it's going to level off. Investors are going to be looking for future growers, and the companies that are investing in R&D and and putting money back into their companies to grow. I mean, that's a really important factor to consider when you're trying to find future growers. In terms of valuations, like, that was a tough conversation a couple months ago. Some of the airs come out of that, that growth surge with those 5 companies that David mentioned, and some of the other companies like them. So we're comfortable with valuations at these levels now going forward. We were less comfortable with them before. The other thing is, like, in general, again, interest rates become a big factor. David mentioned the value today of future cash flows in an environment where the cost of money goes up in the future. That was a big consideration for investors. So you have to, for us, we think if long-term interest rates can stay, in the, over, call it 3 to 5 years in the 2.5% range, we're in really, really good shape from a valuation perspective. The big risk is the economy runs too hot, the Fed ends up behind the curve, they end up having to raise rates really rapidly, and long-term interest rates go up too high, and that's where you can get into trouble. So we're comfortable with the valuations on these companies today. We're not as comfortable with them, a couple months ago.
So I just wanted to comment about something that was made a little bit earlier in describing that graph. So it's worth comparing what the equity market looked like in 2000, 20 years ago,
let's see if we can,
and where it stands today. So 20 years ago, the overall market traded at the index level at around 24 or 25 times earnings. But the median stock, the typical company in 2000, traded at 13 times forward earnings. So it actually wasn't very expensive relative to history. It was a very few number of super caps, super large companies, and were large because they traded at very high multiples. Cisco and Exxon and General Electric. Microsoft actually was one of them as well. These are these companies that were trading at very, very high valuations and helped lift the index valuation overall. But the typical stock was more modestly valued. Today, what is different today is that the index overall trades around 22 times forward earnings, and the median stock also trades at the same level. So it shows that the market, broadly speaking, is at a much higher level of valuation compared with where we were 20 years ago. Now, that's important to understand, because there's several things that were a cause of the downturn 20 years ago, but it wasn't really so much about an economic recession. It was a valuation issue. And the valuation of the market was so extreme at almost 24, 25 times earnings. And ultimately, those big stocks did not deliver the sales growth and the earnings growth that investors were anticipating. The growth, for example, in revenues was expected to be like 15% per year for the next couple of years. This is in March of 2000. It ended up being they grew around 8%. So it still grew, but much less than was expected. That's why the focus on these big companies today that are investing so much money and so much cash into growing their business is so vital. It's a reflection of the idea they're really trying to maintain the growth rates at a high level that arguably could help sustain the high level of valuation. So that's a comparison both where we were 20 years ago, where we are today. And then to pick up on a point Andrew made, it's very important, is the interest rate environment is also quite different today, much, much lower rates. And the argument behind owning the equities today is not so much on the valuation on an absolute basis, because it's clearly very expensive as your chart shows, but really relative to interest rates, it's it's reasonably attractive. Rates are extremely low historically, not the lowest, but certainly low. And valuation of equities looks somewhat more attractive relative to interest rates. And that leaves the individual investor with a challenging decision, right? There's equities which are somewhat expensive relative to bonds and absolutely very expensive, but the return on cash is close to zero and the return on credit spreads are very thin. The other opportunity sets are really arguably quite limited. I would argue quite limited. And so equities becomes a relatively attractive asset class, but frankly, the better opportunities are probably in non-US equities. I know this whole discussion was been focused more on the US equity market, but I think your better opportunities are actually going to be outside of the United States, where the economic growth is still accelerating. The vaccination process is still to come in the future, and all that acceleration is going to be benefiting equities, I believe, sort of outside the United States as compared with inside the US.
That's great, David. Thank you. I want to hand it over to Jorge for questions from the audience. Please go ahead, Jorge.
Thank you very much, Miguel. Some of the questions have come without a name, but there's one question from Pedro David Martinez talking about the NASDAQ, and also combining this question with some others that talk also about a probable adjustment or something. I would like to encompass everything inside a graph that we have there. Do you la gráfica de la ruedita, some graph that we can show, and I would like you to see some kind of roulette of ideas, investment ideas, and thinking about equities, for example. Pedro David Martinez question and some of the questions verse around the topic in value versus growth. We know that if the inflation is transitory, there's no use in going so deep into value, because we know that growth brings gains in the future, and the future will be more inflationary. But if inflation is not permanent, then there is not such a weight on going so hard on value versus or abandoning growth, which means also going maybe not short, but maybe rotating away from technology. And then you can see there some attractive sectors. Maybe old technology will be better than new technology, because new technology is already too expensive. And this old technology means all the Internet of Things that goes into industrials and the machinery and all that. And also more into hardware instead of software because of pricing. We also see the story of inflation in the commodities, copper and industrials. Maybe are we in a super cycle of commodities again? Would that mean, because there's a question about the US dollar, would that mean that the dollar has to go down? Has ever the correlation between commodities and the US dollar been positive? Is it always negative? And also, if inflation is a story of transitory, then we talked about that one.
A lot of questions.
But there's a can we ask you guys about the strategy, the main rotations that are taking place in the head of the investors, and what do you think about those ESG and green bonds versus natural bonds and things like that? Thank you.
Sure, I'll take a step. There's a lot there. What I'll start off by saying is just there at different times there are different regimes or market leadership, and to me, especially with the benefit of hindsight, what we've seen is pretty intuitive. You had the companies that can service customers when, despite the fact that they were all locked away at home during COVID, led the first part of this market rally. Then as it became clear that there was a vaccine and we would eventually come back to something that approximates more normal life, you had another big rotation into the cyclical parts of the market that have a lot to do with, the real economy. And also interest rates have risen. So financials has been an outperformer because banks make more money when they lend out money at a higher fee or higher interest rate. Now going forward, I think people have to have, I know it's a boring answer in some ways, but a more balanced approach between, traditional growth sectors and value sectors in their portfolio, because it's going to be a much more steadier, climb forward. So I think that's number one. In an environment like that, it's going to be a little bit harder to get those double-digit returns. So we think that investors should be focused on certain areas that, we and other institutions across Wall Street have kind of dubbed mega trends. These are areas where you have secular tailwinds. It's not as dependent on the economic cycle. They're more dependent on the structural changes that are happening around the world that, come an inflation cycle or not, aren't really going to change in our view. So just to name a couple high level ones, you're going to see, in our opinion, the continued digital transformation of the way that business gets done all around the world. We think of things like cloud computing, cybersecurity. David already mentioned the shortage right now, in chips that you need in every single electronic device around the world. Like, you can talk about artificial intelligence. There's a huge kind of trend around the factory of the future where robots and cobots work in tandem with human beings to get stuff done, and they're no longer tethered to the floor of the factory but can move around autonomously. Next generation of vehicles. There's all these different things that relate to this mega trend around digital transformation. And then you mentioned ESG. Look, I got to be honest with you. It used to be that when we talked about ESG, it was essentially reflecting a client preference to invest in a more socially conscious or responsible manner, right? And there was this long-held belief that there was some return give up as a result of focusing on these things. Now you've got three really powerful forces coming together at the same time that make this a bona fide profit generator. The three main forces, and they don't get any bigger than this. The first force is government. All around the world, governments, the US has been a little bit of a laggard in recent years, but with the new administration, it's coming on more strongly. But like, governments around the world are tightening restrictions on emissions. They're providing incentives for cleaner energy. So you've got government. The second is you've got real consumer preference. Just look at the conscious, way that consumers are buying, and the trends in wellness and things like that. And then finally, you can have government pressure and you can have consumer desire, but without the technology to actually, ever since I was a little kid and watched a cartoon called The Jetsons, they talked about flying in electric cars, but they didn't have the technology. Now the technology is there to provide, like right now on the market, there's something in the neighborhood of 230 different electric and hybrid models of cars that you can buy. They're nicely styled, they're pretty reliable, the technology is only getting better. We're getting over the hump of, they call it like range anxiety, like how far can the car go? Like we're getting over those humps, and the cost is coming down. So in terms of the trends that investors, are going to start to gravitate to now that like the big growth boom's out of the way and the big cyclical bounce is largely in the rearview mirror. Sorry for the bad pun. You got to start to look to these like mega trends, and that's what I think is going to drive portfolio returns over the next, call it 5 years, 10 years, something like that. Regardless of whether inflation becomes an issue or what have you.
I want to ask.
And by the way, David made a really interesting point that you should think a second time about too, which is that some of these big growth stocks, it's almost like I heard it said somewhere that some of these big tech companies are almost like the utility companies of yesteryear, where people used to flock to utilities companies for their relative safety, their lower beta, their higher dividend yields in times of distress. It's the technology that runs our lives is so crucial to us all now that in another downturn or bad environment, those stocks will continue to catch a bid because they're basically utilities now. You need them. You can't turn them off. And so they do well in a difficult period like COVID, and then they also do well when the economy's growing. So it's a really, really interesting way to think about those big tech companies. You did mention, last quick 2 seconds here, you did mention something about monopoly, like these companies being monopolies and the US government thinking about antitrust rules and stuff like that. In a blanket statement, I would say that in general, we're not too concerned about it, largely because if you break up a big company like the ones that David mentioned, you can make a very strong argument that they're more valuable on a sum of the parts basis than they are together. So fine, break them up, they'll still make plenty of money. They'll carry even higher multiples as individual business lines. I'm not too worried about that one.
That's interesting. That's quite interesting. I want to ask you both guys around cryptocurrencies, and all these Dogecoin. Dogecoin is more valuable than Philips or America Mobile, which is very relevant here in Mexico. I mean, what do you make about? Is it a real asset or not? What do you think?
You go first.
Well, it's a hotly debated topic. Individuals both on the portfolio management side and inside Goldman Sachs have strongly differing opinions on the subject. The volatility of the prices, whether it's any one of the cryptocurrencies you mentioned, the volatility would suggest it's not very much a store of value because they fluctuate so dramatically. In some aspects, it's a medium of exchange, although because the valuation is so significant, the idea of buying a Tesla car for 1 Bitcoin, for example, well, the Bitcoin may be worth a lot or maybe worth a lot less. Are you overpaying or underpaying for it? So not so clear that the medium of exchange, exactly how that's likely to play out. There's lots of different coins or different cryptocurrencies. So are you going to not make your bet, but are you going to choose to be embracing a particular one of the blockchain currencies, or are you going to try to participate in all of them? So I think there's some interesting challenges around sort of understanding it as an asset class. I think it has been accelerated the enthusiasm around it because of the extraordinary performance in you've had over it's went up a lot, then it came down and came up a lot, and it's come down, but it's been hugely volatile over the last several years, plural. And so I think individuals are trying to sort of establish where does it fit. Is it a digital substitute for gold? Are they concerned about the debasement of currencies because all of these governments around the world have been trying to invest and run deficits in order to help bridge the economies into past the pandemic? So there's a lot of confluence of events as to why I believe that it's become very, very prominent. How do I think about it? I suppose one could have a small allocation to it as an individual if you so desired to have a certain amount of risk. I think the question is, for what purpose is it designed to serve in your portfolio? And I said, is it a store of value? Is it stable? That's not so shown to be the case. Is it a diversifier? Is it likely to do better in an inflationary environment versus a deflation environment? So there's not a lot of historical experience about what are the attributes in hostile markets, things like that. So I would say it's on the margin, a potential alternative asset class that somebody could own. I sort of leave it at that. We continue to have debates both internally as well as with clients. Some clients are big believers. Some think it's not. It's a fad and not worth anything. So, Andrew, back over to you. I'm sure you had some thoughts on that as well.
Yeah, I mean, look, anytime you get a parabolic, like first of all, let me just give you like a quick economic and market rule of thumb that will serve you well in your lives and careers. In general, anytime you see a chart where the left-hand side of the chart looks like the Eiffel Tower, you're probably going to see the right-hand side of the chart look like the right-hand side of the Eiffel Tower. That works on the way down. It works on the, like, look at COVID on the way down. We bounce back. You know, some of these things. But anytime you see something that goes parabolic in price, it's going to get a lot of attention. And, you know, and so I think the first thing I would say is never, ever invest more than you can withstand to lose entirely. So if you can afford to invest $1,000 and lose every penny, like, fine. But if you are investing and you cannot afford to lose it, don't do it. One rule of thumb that I heard that I think makes sense is for our client base, which tends to be wealthy and ultra wealthy, for people who are really interested, 1% of your portfolio. Why 1? Well, if it goes to 0, you're left with 99. But if 1 continues to be parabolic, then you've made yourself some money. So the last thing I'll say is, like, let's understand fundamentally what's going on here. And I think David said the key word, which is blockchain. Okay, it's not necessarily about the cryptos per se. What happened is, throughout human history and in early human history, if David and I wanted to, like, let's just say I was a fur trapper and David grew corn, and I wanted to swap, I needed corn, he needed fur, whatever, we'd barter, we'd swap. What happens when I needed, corn and didn't have any fur to offer? And he would say, look, I don't trust you, dude, you're in a nomadic tribe. He would bring in a third party who would chisel down in stone somewhere that I owe him 1 fur. The point of that was, it was a ledger, a third party, verifiable, trustworthy ledger to keep track of this transaction or the debt that was created, okay? It went from that to banks. That's what banks do, right? Banks keep all those transactions and ledgers for us now, right? We trust the bank, okay? All of a sudden, enter blockchain, which is a highly verifiable digital version of a ledger, such that now if I wanted to transact with somebody like David, I can have the whole force of the internet basically verify that he's good for it and that the coins he's giving me are truly and verifiably his. That platform has given rise to this rush of coins that people can now use to transact between each other. This reminds me of, when I first moved to New York City 20 years ago, it was at the onset of social media. And the way I went on the computer to try and meet people in my neighborhood, which is kind of a nice way of saying that I used this platform called Friendster, which no longer exists. And then I went to MySpace. Then MySpace became the big thing. No one I know uses MySpace anymore. Then of course Facebook, then Instagram and Twitter and and TikTok. And so who's going to be the ultimate winner in the crypto game? It's way, way, way too early in the life cycle of this asset class to know. What's much, much more interesting to JP Morgan and to Goldman Sachs, and I know this because I read your work, is the ecosystem around the platforms, right? And around Bitcoin. So for example, a company, I'll use Coinbase as a reference. This is not a recommendation for the stock or not. But just simply put, if you don't care and you're agnostic to which coin becomes the ultimate long-term winner, David looks like he's got to go in a second. But if if you're agnostic as to which coin's going to be the winner in the long run, but you grow with the growing space, that's great, right? So just a couple thoughts. We think it's an asset class that's probably here to stay. It's not yet ready for prime time as a means of currency or transaction, and I'll leave it with that.
Thank you. You were saying, I think we're running out of time. We just got caught in the conversation, and you said, David, you have to run. You have time for one last question?
I am. One last question, then I have
okay.
a meeting at 3:30.
Great, let's go.
Yeah, thank you very much. People are asking about Mexico, and I know it's a little part of your portfolio. Maybe it's 2% of the world GDP only, or less now. But what do you see in Mexico? You see a red, you see a yellow, you see a green. Of course, there are opportunities, but how do you see that in your portfolio, and your daughter too?
Well, as I said, from an analytical point of view, there are a couple of things to keep in mind. Number one, the single most important driver in every country around the world is the vaccinations and the ability to get the medical, the vaccines to the population, to get herd immunity so the economy can restart. Number one most important development. And so to the extent that that is going to be able to be distributed, and most importantly, people get vaccination, that's a positive development. Again, in the United States, we're already close to 50% of the population has been vaccinated, or in some cases already had COVID, so is somewhat immune. So it's actually getting close to 60%. We're pretty far along the way there. That's a positive, and that's helped the economy restart, number one. Therefore, where Mexico is on that evolutionary development chain is to come. And so as that's going forward, that's a positive, number one. Number two, the idea of better returns outside the United States is a general view that I would embrace and support. My colleague Cesar Mazzari is our kind of emerging markets equity analyst and more knowledgeable about individual countries, but as a general statement, would rather own that because we have a view that the dollar is going to be weak. And so therefore, as a US dollar-based investor, one should be owning an increasing ownership allocation to non-US equities. And the third issue is to say, well, that is in fact where people are investing their cash, because we look at money going into US mutual funds, both passive and active, and the money is going into international products that are investing overseas as opposed to domestic products. Of course, there's some coming into domestic products, but an increasingly large percentage is being allocated to non-US. So those are some of the things why I would be more optimistic around this. Hopefully, the trade situation would also improve, some of the issues on the border. There are some issues that need to get addressed, but broadly speaking, we're pretty optimistic with respect to economic growth in most of the economies around the world. Again, I come back to the point about vaccinations. I apologize, but it's 3:30, and we're supposed to end a quarter of an hour ago, so I'm booked at another meeting. So I appreciate you inviting me to participate, and I hope you have a good afternoon and the rest of the conference.
Thanks so much, David, and thank you so much, Andrew. This has been great.
Andrew.
Thank you, and thank you
guys.
everyone
David,
for
it's great
participating.
to see you.
Thank you.
See y'all.
See you, everyone.
Thank you
Thank
very
you,
much.
and good afternoon. Thanks for participating. Goodbye.